Coldplay, Speed of Sound. It's Jules Schiller on ABC Radio. Coming up before the end of my show, Richard Clapton. He's been touring Australia for 40 years, worked very closely with INXS, author and singer of songs like Capricorn Dancer. What a great musician Richard Clapton is. He'll be joining me very soon. But let's get on to housing. We're very careful when we discuss housing in Australia, aren't we? We rarely use the term expensive or overpriced. We always talk about affordability. And the concept of affordability is particularly relevant to first home buyers who, unless they're beneficiaries of a large estate, have to devote years and years of saving just to scrape together a deposit. But the time to save the deposit varies wildly from state to state, and Bank West have compiled data from the ABS and CoreLogic to calculate the length. Now, these figures have to stay with me here. They're using the average housing prices of each city and the combined average salary of two people aged between 35 and 34 who save 20% of their pre-tax income in high-interest savings accounts. So, the Times have calculated to save a deposit in various cities around Australia for first home buyers. In Sydney, it's 8.2 years. In Melbourne, 6.4. Brisbane, 4.5. Adelaide, 4.2. And Perth is 3.9. Here to talk about this and some of the realities of first home buyers attempting to get into the market, I'm joined by Principal of Digital Finance Analytics, Martin North. Thanks for coming on the show, Martin.
Hello, good to talk to you.
These are pretty long periods of time, and of course, they kind of assume that people aren't single. Do you think 8.2 years in a city like Sydney is too long?
Well, there's no doubt that it takes way too long to assemble the deposit, and you're right, that the scenario that they're talking about is two people working full-time and saving 20% of their pre-tax income into a high-interest savings account. I mean, there are so many people who are not able to do that, so I would suggest that those time frames are relatively optimistic, even if you took a good view to it. Many people are really finding it almost impossible to be able to put that deposit together.
This is what I was going to say, Martin. They assume that you're in a steady relationship, and relationships can be a bit more frenetic in this day and age. People are doing more contract work than full-time work, and in 8 years, if you're in Sydney trying to, relationships change, jobs change, incomes change, obviously living expenses when it comes to things like utilities are going up. So it's a lot harder than these figures might suggest.
Yes, it is. And in fact, if you look at it from a trend perspective, about half the people in that age group are now able to buy compared with just a few years ago, right? So there's been a continual trend over the last 10 to 15 years. It gets more and more and more difficult to get into the market. And interestingly, the slight peak in first-time buyers that we've seen in Sydney and Melbourne have been in direct response to government stimulation to try and help first-time buyers into the marketplace. But we have a much more difficult structural problem here than just, a little bit of help for first-time buyers to try and get in. It is almost impossible now for many people to get into the market. In fact, if you don't have money from family, it's probably quite difficult. So the Bank of Mum and Dad is something we look at quite a lot, which basically says if you've got money from your parents, you might be able to get in. And the average amount they get from parents is $80,000. So
what? I'm going to ring my dad as soon as this interview ends.
Yeah. Exactly. I mean, it is remarkable, but in fact, if there's this intergenerational thing going on, and for many people who are first-time buyers, they're unable to save sufficient, and unless they have parents who effectively are sitting on equity in an existing property, they may well never get into the property market.
And of course, with people living longer, which I'm not saying is a bad thing, it means that inheritances come a lot later in life for a lot of people now. So first home buyers, if they are looking for money from their parents, might have to wait a considerable amount of time. Do you think, Martin, that eventually, if it's 8 years or perhaps more in many other cities, that eventually you put housing out of reach? It takes so long that people just won't bother?
Yes, it's clear to me that we already have a generation of renters, a generation of people who will always rent rather than actually buy. Some of it is because of choice, because they like the flexibility, and to be frank, they want to spend their money on other things, but a lot of people have no choice at all. They've got no choice but to rent. And it's partly a sort of a counterplay to the very significant growth in investment properties that we've seen across Australia in the last few years. And of course, if you put that all together, the reason that home prices are so high is because of the extra demand created by all those investors piling in and essentially owning an investment property and then renting it to those people who can't buy their own property. So it's a bit of a vicious circle that we've created for ourselves here, And that's why I'm saying it's a structural issue here. We've got interest rates probably set too low at the moment. We've also got this investment incentive for investment property owners, and that means that a lot of people are excluded from the property market. And if you look at the overall trends, it continues to drive more people to rent. And interestingly, later in life, as people begin to move into retirement, they haven't paid off that mortgage either. So effectively, you've got a greater proportion of people with mortgages for longer as well.
Martin, I mean, one of the things that were really secure about the Australian housing market was that people would fight to save their own homes. So even, during times of economic shock, people would do what they had to do to save their own home. But with the amount of investor properties in Australia at the moment, would you think that is dangerous in an economic downturn? People will throw a lot of those properties on the market all at once, which might have a pretty devastating effect on housing prices everywhere?
Yes, so that's a very important point for people to understand. So the theory has always been that, as you say, people hold onto their properties and will do everything to hold onto it. But investors are a different class. They only hold property when it actually makes a return for them. And if you look at what happened in Ireland and in the UK and in the US, when there was an economic downturn, all of the investment property started losing value, and people then started bailing out, and they all started bailing out together, and that was one of the negative feedback loops that created a downward pressure on property. That's one of the reasons why we think there are probably higher risks in the market than is currently understood at the moment, because investors will vote with their feet, and essentially if prices begin to slip, they'll try and get up early and quick.
So if you try and get first home buyers into the market, and these figures obviously indicate that it's going to take a while, and you give them some incentive, and state governments and federal governments have tried to do that, then you're getting first home buyers into houses that they might try and fight to save, Martin. Still, it's going to increase the prices of property everywhere as well, isn't it?
Well, that's the point. It's like water coming into a harbour. It lifts all of the boats, right? So if you try and incentivise first-time buyers and give them tax breaks or stamp duty relief, it just lifts the price of the property. It doesn't actually solve the fundamental problem that we've got, which is that prices are way too high relative to the average income. And in fact, we've got some of the most indebted households and some of the highest prices in the world because of our policies over a generation. And therefore, we've now got to, I think, stand back and really start thinking not just about sort of tactical little incentives here and tweaks there. We need a much more structural reform of housing, because housing fundamentally should be somewhere to live, not a generator of future wealth, in my view.
There's a real tale of two coasts in these figures. Sydney, 8.2 years. This is the figures from Bank West, Martin, and Perth, 3.9. So while a lot of people on the East Coast will kind of assume that properties will keep going up because they always have gone up and there's no reason for them to taper off or go down, people in the West are experiencing what can happen to property during a slight economic downturn, aren't they?
Well, they are, and it's interesting. I've done some work quite recently looking at the Perth market, and there are some suburbs over in Perth where prices went from a sort of $500,000 up to $800,000 and then down to $600,000 over the last 5 or 6 years, right? So you imagine the wild ride of prices going up and then coming down. Prices can fall, and in fact, if you look around the world in a downturn, if they can drop 25, 30, 35% over, let's say, a couple of years. And we shouldn't imagine that Australia is somehow insulated and special, because it's not, and we've already seen in parts of Australia prices falling. They're falling already up in parts of Queensland, in the mining belt there as well. So essentially, we need to be very careful, because if we just assume that prices will always going to go up, we can actually dig ourselves into a very deep hole. And many people who are buying in, first-time buyers, are buying in right at the top of the market, so they need to be careful.
Well, that's my next question. A banking survey has said here's how much time you need to save for a deposit to get your house, but then they're not asking the question, is it the right time to buy a house? And that's, I think, what a lot of first-time home buyers would be asking themselves at the moment.
Yeah, I have a view that if you can manage to make your mortgage repayments if interest rates were 3% higher than they currently are, then you might consider buying now. But otherwise, I would be very careful, because the chances are prices from this point in time will go backwards rather than continue to increase, and we are expecting interest rates to rise, not immediately, but probably 2018, 2019. And of course, incomes are sort of not growing at all in real terms, and cost of living are still quite strong. So put all those things together, and the standard affordability tests that the banks use, I think, are not conservative enough. They're allowing people to probably borrow more than they should. So you need to do your own sums, and you really need to be sure that it's the right thing to do. At the moment, if I was a first-time buyer, I would be thinking twice.
And Martin, if we do accept that there might be a slight bubble and some housing in Australia might be overpriced, and stimulus and those kind of tactics are not really going to do anyone any good, is the question for regulators, banking regulators or a government, to deflate house prices slowly and without causing too much of an economic ripple? And how would that even be possible?
Well, it is very hard to control house prices, and in fact, the Reserve Bank, for example, says they don't control house prices. They haven't got a house price target, because it's an outworking of so many other things: where interest rates are, the amount of demand that there is, the price of land, all of those things together. And of course, it's all a mixture of state and federal, because a lot of the building work is actually done at a state level, and the planning is at a state level. So essentially, it's very hard to get an orchestration of all the elements that are required to be able to do this gently. My view is the settings that we've currently got at the moment, if I think in interest rates they're probably too low, I think we've probably not got so much of a supply problem as many people have claimed. And so effectively we've probably got more property coming onto the market than the prices will currently sustain. So my own view is prices will certainly slide, and it becomes now a question of whether they will slide gently over the next 2 or 3 years, or whether we'll start moving more quickly downwards. And of course, if they do move more quickly down, we go back to our investors and then dumping property at that point. We are really on a knife edge here, and there are lots of uncertainties about how the market is playing out. But I don't think that people should assume that next year and the year after is going to be very positive for home prices.
I'm speaking with Martin North, Principal of Digital Finance Analytics, about how long it takes first home buyers to save for a deposit and the housing market in general. Martin, do you think the Banking Royal Commission will find anything will help housing at all, or do you think it will investigate properly some of the banks' leverage in relation to the mortgage market?
Well, it's an interesting question. I've had this theory for a long time that we should have had a Royal Commission on housing rather than banking, but that's another story. Look, the fact is that there is definitely some suspect lending that's gone on over the last few years, and in fact all the major lenders now have tightened their lending criteria compared with 2 or 3 years ago. So from my analysis, and I'm looking particularly at mortgage stress, I know that there are households who have mortgages today that they could not get now simply because underwriting standards have been tightened. So we know that there was a lot of looseness there. There's a lot of competition in the market to try and write business. So I think we have got quite a few households who are absolutely leveraged up to their eyeballs and are really struggling to make those repayments now. I'm not sure whether the Royal Commission will have a chance to look at this, but I think they certainly should, because I do think that the biggest sleeper at the moment in the financial sector is poor lending practice, and I think we haven't yet seen much evidence, but I think there's going to be more evidence coming out over the next 2 or 3 years.
Do you think the influence of foreign ownership of Australian homes is overplayed or underplayed? Do you think it's a positive influence in our market? Do you think that banks have not been doing their due diligence on some of these foreign buyers? What's your opinion on that, Martin?
Yeah, I think foreign buyers have definitely stoked some markets in some places, but I don't think it's as big a factor as many people have claimed. And many of them, of course, bring money from overseas rather than actually borrow from local banks here. And, of course, they are required to buy new property rather than existing property, although, of course, that really wasn't being managed and policed very well until quite recently. So I think my net view is that foreign buyers probably are a net positive in terms of creating supply and creating more opportunity. But nevertheless, in some postcodes, first-time buyers are headbutting right up against those foreign investors even now, and therefore find that prices are higher and more difficult to buy. So it's a factor, but I don't think it's the fundamentally critical factor that explains how we've got into the mess we've got into.
And if you are looking to invest in property, even with everything that we've discussed, Martin, are there areas in Australia that would be good places to invest?
Yeah, there's no doubt that you can't think of the Australian property market as a single one-size-fits-all market. There are some very different markets around. For example, Adelaide is a very interesting market in my mind. Prices are not as high there. There isn't so much demand. But in fact, momentum is not huge in Adelaide, although there are some investors buying from interstate into Adelaide. I think that Tasmania is a really interesting place because even there, prices have risen quite strongly in the last year, but they're still quite a lot lower than in other places. So it depends where you want to buy and what you want to buy. If you want to buy for investment purposes, don't assume that the major markets of Sydney and Melbourne are necessarily the right places, because rental returns are much lower there than, say, in Tasmania or indeed in Queensland or indeed in South Australia. And if you're a first-time buyer, clearly that's going to be more about where you're working and access to your place of work and other things. But if you have got flexibility in where you buy, do think beyond the square and think about other places, because there are some quite interesting opportunities even now.
And finally, before I let you go, Martin, I think the fascinating thing about this study to me says that only couples are really able to buy houses now in a realistic point of time, and in 2017 people are staying single for longer, some are never getting married. There's a lot of couples that are getting divorced and splitting these assets. So at the very time when social relationships are becoming more fractious, we're actually saying if you want to buy a house you need to almost be in a 1950s relationship.
Well, it is weird, but of course many people are buying with friends, so 2 or 3 people clubbing together. But all of those sort of informal relationships have a whole bunch of risks to them, and as you say, people tend to not stay in the same relationships for so long. So yeah, we're institutionalizing a whole bunch of things that probably from a social perspective are not very smart, and from an economic perspective doesn't make a lot of sense too. But it goes back to this fundamental issue: when you've got massively high house prices because of failure of policy, then people will try and do whatever they can to get around it. But I think we need our politicians to really step up and understand that there's a really big issue here that needs tackling top down, rather than just sort of dealing with little bits and pieces and hoping that somehow it'll magically cure itself. It won't.
Martin North, I really enjoyed our chat, and thank you so much for coming on the program.
Good to talk to you. Thanks.
That's Martin North, Principal of Digital Finance Analytics, talking about that study. It was on the ABC website today about how long it takes for couples between 25 and 34 on a average income combined to save for an average house in their particular city. Next up, we're going to talk to an Aussie singer who has seen it all in a career that has spanned more than 40 years, Richard Clapton.
Every match.